Everybody, I hope you're enjoying the last bits of summer here. Next week, we move into September. Kids back to school, a little more structure, if you're like me in life, which could be a good thing. But hopefully, this warmth that we are experiencing right now continues through September. We get a bit of an extended summer as far as the weather goes. Got a few charts for you. Markets have been a bit choppy, but stayed relatively positive, especially with the rally that we've seen. So this is a chart looking at global stocks, excluding the US, and you can see that a lot of the growth we've seen recently has been in the US market and the North American markets. Globally, markets haven't been as hot. We've seen this rally lately picking up and moving through the new highs that were set back in 2007. So we are just kind of moving through those right now. A good sign that there could be more to come on the global markets as the markets haven't been great over the last 10 or 15 years or so. A good indicator and a good reminder to stay diversified globally, and that's going to help you in the long run as markets move. This chart here, a bit cluttered, but this is looking at the VIX, which is an indicator on volatility in the market. And you can see in the top left there, the current drop in that volatility indicator. So from those April lows that we saw, or where that volatility really spiked, it dropped 69% in the volatility factor in the markets. This continually and smoothly moving up. And when volatility drops, that's a good sign for markets, as you can see on the right-hand side of that chart. Anything a year out, and really even the 6-month indicator only has one negative there, but anything a year out is positive, and a lot of those gains very high returns over the 1, 2, 3, 4, and 5-year marks when that volatility drops. Markets don't like that uncertainty, so as volatility comes down, markets tend to generate excess returns. We'll see if that's the case this time. Of course, there's corrections in all of these, and markets moving up and down, but overall, in the long term, some good returns when volatility drops, as we've seen over the last 4 or 5 months. Another chart that's going around the markets and this idea that stocks are overly priced, overvalued right now, and it may not be incorrect. If you look at this chart, we are at all-time highs on the S&P 500 for a number of indicators on the price side of things. And we've, of course, had this rally in the markets. Again, could be corrections from that. But looking at it another way, if you look at the equal weight, so taking out the overvaluations of some of those big tech companies and the capitalization, and what percentage, as I've talked in previous videos, what percentage of the index those big 6, 7 tech companies have, that light blue line, the capitalization weight, the price to earnings is very high. But if you look at it equal weight and spread that S&P 500, 500 for each company, you can see that the underlying and the rest of those other called 493 stocks are much more regularly priced if you're going back over the last 10 years or so. So another indicator and another reminder to stay diversified. And just because you're in the S&P 500, if you're not in an equal weight portion of that, then you are overweight those higher priced tech companies. Again, doesn't mean they don't continue to move up and be even higher priced, or as we've spoken about before, earnings continue to grow and bring those price levels ratios back down. But a reminder on the diversification side and just where the price is when you see that in the charts. Here's a couple interesting charts we like to end with a few times. So this is the estimated percentage of 30-year-olds who are married and homeowners. And you can see that rapid decline. We were over 50% if you're going back 60, 70 years. Now down under 15%, getting towards 10% of people who are 30, married and homeowners. So just an interesting trend. I don't think it really surprises anybody that this has happened. Numerous reasons why this has happened. But an interesting chart, something to think about how society has changed over the last 50, 60 years. And here's another interesting one for you. So going along the lines of that and a shorter term history, the average age of a first-time home buyer, this is U.S. data here, but you can look back in the early 2000s, 31, 32. and through the financial crisis, even dropped down to 30. You can see we're at 38, and it's rising fairly drastically over the last few years here. Again, lots of reasons for this. High home prices, of course, the pandemic being something that skewed things a bit. But you can see that average home buyer age is moving up. And also many just not buying homes at all and continue with that renting plan. So interesting. We'll see where these charts go over the next few years and see if that continues to move up. Anyway, thought that was interesting for you. Again, enjoy the last bits of summer here. We'll be back in September with another video and some more charts. I look forward to seeing you all then. Take care.